Okay, so the market was absolutely on fire, right? Just smashing all-time highs, and then suddenly it just slammed on the brakes. We're not talking about a crash, not at all, but a really significant pause. So the big question is, what happened? What exactly stopped that rally in its tracks? Well, that's what we're going to unpack today. All the forces that brought the market to this big standstill. You have to wonder, right? Was this just some simple profit taking, investors cashing in their chips after an amazing run? Or are we seeing something bigger here? Maybe the very first signs of a real fundamental shift in who's actually leading this market. Let's dig in and find out. And real quick, just so we're all on the same page, everything we're about to look at is based on the market close on December 8th, 2025. So here's the game plan for today. First, we're going to see how the market just caught its breath. Then we'll get into the nitty-gritty, the forces that were actually driving that pause. After that, we'll follow the money and see the rotation, the winners, and the losers. And finally, we'll wrap it all up with an investment playbook to help you navigate what's next. All right, let's dive right into section 1, a market catches its breath. We're going to start with the big headline numbers, and honestly, after the kind of rally we've had, seeing a little bit of a pullback isn't exactly a shocker. So let's see how the major indices actually fared. So the S&P 500, which is, our best gauge of the overall market, it dipped by about 1/3%. This is pretty much a textbook case of profit taking when you're hanging out near all-time highs. Now, here's where it gets interesting. The NASDAQ, which is packed with all those big tech stocks, it barely even budged, down just 0.14%. That relative strength is a super important clue. It's telling us that some of those big tech names were really holding their ground. But, on the other hand, you had the Dow Jones. It took the biggest hit of the three, dropping by 0.5%. And that signals pretty clearly that the real weakness was in those more traditional, industrial companies. So, this brings us to the key theme of the day, this idea of the market catching its breath. It's super important to understand this isn't a panic. It's just a pause. It's like the market sprinted a marathon, and now it needs to stop, take a drink of water, and figure out its next move. You can really think of it as a healthy, necessary cooldown. Okay, so if the market was just taking a breather, what exactly caused it to slow down? What were the forces at play? Well, it really boils down to three major factors that all kind of converged at the exact same time. It really was a bit of a perfect storm. So first up, you've got rising bond yields. The 10-year Treasury yield climbed to 4.17%. Now, why does that matter? Well, it makes super safe government bonds look way more attractive compared to taking a risk on stocks. Then, pile on top of that some major policy uncertainty coming from the president-elect. And, as if that wasn't enough, a really influential analyst comes out with this bombshell call to start rotating away from big tech. Talk about a triple whammy. And let's just pause on this quote from Ed Yardeni for a second because, wow, this is a huge deal. For the first time in 15 years, he's telling his clients to sell the Magnificent Seven, the giants, and instead buy the other 493 stocks in the S&P 500. This is not just a minor adjustment. This is a potential earthquake, signaling a massive shift in market leadership. And that political uncertainty? It's creating some serious headwinds for the market. I mean, if there's one thing investors hate, it's not knowing what's coming next. And right now, you've got the president-elect hinting at getting involved in mergers and acquisitions. There's talk of a new 25% tariff on NVIDIA's chips going to China. And with China's trade surplus hitting a record, that just adds fuel to the fire. It's a perfect recipe for investors to just take a step back and be more cautious. Okay, so with all these pressures building up, the big question is, where did the money flow? This is where we get to see that great rotation theory play out in real time. So let's follow the trail and see who came out on top and who got left behind. And this chart just tells the whole story, doesn't it? Take a look at the tech sector. As a whole, it was basically flat, and that's almost entirely because a few heavyweights like NVIDIA and Broadcom held it up. But then you look at consumer discretionary, we're talking about companies like Tesla and Netflix, and they got hammered. This is the rotation in action. It tells you investors aren't just dumping tech across the board. No, they're getting way more picky. But here's a twist. While the overall market was hitting pause, there was another story that was absolutely heating up: mergers and acquisitions. We had this huge all-cash hostile takeover offer for Paramount from Warner Bros. And then, bam, IBM swoops in to buy Confluent for around $11 billion. This kind of action is so important because it shows there is still a ton of money out there just waiting to be put to work. And it's creating these massive individual winners even on a down day for the market. And these are the perfect examples of how a single stock can have a great day even when the rest of the market is down. You had Paramount absolutely surging on that takeover news. Nvidia popped once investors got a little more clarity on the whole China tariff situation. And check out Carvana. It jumped over 10% just on the news that it was being added to the S&P 500. These stories show it's not always about the big picture. So that brings us to the most important question. What do you, as an investor, do with all this information? How do you navigate a market that seems to be shifting under your feet? Well, it's not really about being right or wrong. It's about having a clear strategy. So let's look at two very different ways you could approach this. But before we pick a strategy, let's just gauge the overall mood of the market. The VIX index, which a lot of people call the fear gauge, it ticked up a bit, so a little more anxiety in the air. But at the same time, the fear and greed index, it's still hanging out in greed territory. So what does that tell you when you put them together? It paints a picture of, let's call it cautious optimism. People are still feeling pretty bullish, but maybe, just maybe, they're starting to look over their shoulders a little bit. So this really lays out two distinct paths forward. On one hand, you have the aggressive strategy. This is where you lean into this rotation. You're betting that the money will keep flowing into those undervalued sectors like industrials and financials. The big risk here, though, if bond yields keep climbing, it could really hurt these growth-oriented stocks. On the other hand, you have the more conservative strategy. This is all about playing defense. You move into safer, more stable sectors like healthcare, or you use an equal weight fund to avoid being too concentrated in big tech. The main risk for this approach? If inflation rears its head again, the Fed might not cut rates, and that could hurt even these value-type plays. And all of this brings us to the big final question we have to ask ourselves. This shift away from just a tiny handful of tech stocks dominating everything, it feels like a big deal. But is it the real thing? Is this the beginning of a healthier, broader market where more companies get to share in the success? Or is this just a quick little detour before everybody gets nervous and rushes right back to the same old, familiar tech giants? The answer to that question is going to do a lot more than just decide what happens next week. It could very well set the tone for the entire year ahead.